Welcome to another episode of Commercial Property Roadshow. Today you're here with Helen Tarrant. Today I'm going to talk to you about commercial property syndications, or group deals, or joint ventures, whichever way you like to call them. And the reason we talk about group deals, syndications, or joint ventures is because sometimes when you're doing a deal, the deal is actually too large for you to do on your own. So we've many times held groups of our students and other people that have met each other at either meetups or other groups come together to do a group deal. Now, there's lots of different ways of participating in a group deal or syndication. Now, on a smaller format, you might want to do what we call joint ventures, which is 50% of your entity or yourself joint venturing with other people who are 50% as well ownership. So that's 50-50 on the actual document, on the actual contract, and you split everything 50-50 moving forward. The other alternative is to look at a unit trust where you sit on top, where you have a company on top, and then it flows through different units, and you can have 5-6 people there. So there is lots and lots of different ways of putting the unit trust together. And now unit trust must be people that know each other, or if you're looking at putting together unit trust, there is in Australia the 2-12-20 rule, which is no more than 2 million, 12 within 12 months. And also with no more than 20 investors. So that means that if you're putting something together, you're raising money. If you're buying a property at 50% leverage, you might be looking at a property that's about, say, 3.5 to 3.8 million, because you've got to take into account stamp duty and things like that as well. Now, the other option to do it is do it in a company, whether you do it in a private or an unlisted public company is also an option. When you do it in a private company, what happens is that they become shareholders in the company. Of course, there's different tax benefits for different ones. So if you're doing it as a joint venture, everything becomes 50-50. So let's say the property earns $100,000 in passive income. What you get is that passive income is distributed 50% to owner A and 50% to owner B. If you are in a joint venture situation, you have that $100,000 in income. What happens is, and then you have say 4 unit holders underneath, each gets 25% share of it. So each person ends up with $25,000, and they pay their tax individually on that $25,000, just like if it's a joint venture. Now, if you have let's say you have a company, and you have that $100,000 coming in. Well, you might be, depending on how you work out the franking credits, you might have to pay tax first before you distribute. So let's say you pay 30% tax or thereabouts, you're left with $70,000 of that $100,000, and you actually then pay out to your investors. So let's say that you have 10 investors and you're paying out $7,000, so $7,000 each investor. But what you're paying them is basically a $10,000, but $30,000 of that is already taxed, and they get $7,000 in their bank account, and so they can claim on that franking credit when they do their tax return. Now, there's different treatments in terms of the future when you sell the property and how you do the capital gains as well. So one of the basics today I want to take you through is why you would do a syndication, and what are some of the upsides and downsides of a syndication as well. So we are going to use some simple structures. So I'll lay out the 3 structures that we typically would do a syndication. And of course, one of the main things that you really need to look at is the meeting of the minds. So everyone has to be super clear of what the goal is, and you have to be able to project forward in the next 3 to 5 years how the deal is going to be structured, which means that if you were to looking at selling the property in 5 years, you can look at, okay, what potentially is this property going to be worth in the future, and how are we going to treat the capital gains? Or if you're going to develop on this property, how much money would you put into this property to develop and look forward to moving forward in the future as well? So that's also one of the different options. So I want to share with you, this is just a selection of the properties deals that we've done recently. So we've done a medical centre rebuild, or a build down in Albury in New South Wales. We've done a self-storage property in Kincumber. We've also done a childcare centre that we're actually subdividing from a shopping centre and then selling them separately up in Townsville. And also we're doing we have done a petrol station build, which is what we bought the land, and then we got this petrol station to be developed out and then got a 10-year lease on it. We do this because there is a front end as well as a back end. If you're doing a pure development like we're doing in Albury, then there is no front end, as in there's no cash flow, but there is upside in the back end. Whereas if you were doing something like a subdivision, then like the childcare centre, there is cash flow in the front end, and then there is a back end as well as when you sell the property. So different projects have different layout, and you need to outline clearly how the deal works. So I'm going to just use an example of if we were buying a $2 million property and you're using to raise money. So I'm going to draw it out on the whiteboard. So come and join me. Let's say you're doing a joint venture. So let me pop that in there. A JV. So that's 50-50. So that's 50% and 50% joined, right? So when you go into contract, it will be ABC and EFG. So PTY LTD, PTY LTD. So that's how you would do the syndication. The second one you would do is what we call a unit trust. So the way that we would do that is we have a unit trust. It has a corporate trustee underneath, which is a company. So that might be, you know, X, Y, Z, PTY, LTD, right? Company. And then underneath you might have unit holder A, unit holder B, unit holder C, unit holder D. So that's one of the options. And that's why you have the different sort of types. Then, of course, you've got number 3, which is you've got a company or so you've got a company, and it can be either a private or unlisted public. Now, one of the upsides about this is that, say we have $100,000, that distributes 50 and 50%. Everything gets distributed equally, right? If you had $100,000 here, everything flows through here, and then you get 25% here, 25% here, 25% here, 25% here. And so the 25% goes to, you know, each of the units individually. Right? Then, but if you're in a company, then it's basically shares in a company, and you have to pay tax on income and then distribution. So that's the difference. And that's a real difference in the actual difference of the way you would structure the syndication. And really, when you look at syndication, the whole point of it is actually to be able to structure it. So in the future, you can reap the gains of it or what you want to do with the property. So let's have a look at if you were doing a new property. So let's say the property is $2 million. Let's just say that for what argument's sake is a 5% yield. So it gives $100,000 in income. Let's just say it has development potential, and that the development is going to cost another $2 million, right? Let's just say that is the scenario. So this is the example. So what happens here is each year you might have some costs. So let's say there's maintenance, management, accounting costs. So let's say all of these costs adds up being 20K. So you're netting 80K. Right? And that then becomes distributed depending on your structure, and depending on the structure we've talked about before, whether you're a joint venture, unit trust, or whether you are actually looking at a flow-through, more flow-through structure, or whether you're going to do a company. Right? So it's different between the structure. Now, 2 mil if you have the development potential. So let's say that everyone did this with cash. So we each raised with cash. And so that's a cash buy here. So this is a cash buy. So, you know, if you're part of a unit trust, let's say you're 25%, you put in 250,000. If you're doing 50-50, put in, 500,000. And let's say you're one of the 10 people in, a company, you put in 200K. So you put in cash, you use the cash, you bought it, you got the 5% yield. Now you might go and borrow. So let's say you borrow. Because you own the land, you're going to go and borrow 50%, which is quite easily can be leveraged against the land, especially it's got a return. You go and borrow at the 2 million. Let's say that, the 2 million you're going to borrow, and you're going to be doing this at, let's just say, the interest rate or something like that might be, say, 4%. So that you're borrowing 4%. So what that is 80K in terms of income, in terms of interest. So now these two are the same. So there's actually zero income. So there's zero income, so there's going to be no distributions. But what's going to happen is you're probably going to kick the tenant out. You're probably needing to build on it, draw down on it. So it means that that between you and your partners will have to contribute more to the property. But then you're going to build on it. Let's say once you build on it, you lease it. The property is now no longer worth $4 million. It's worth, say, $5 million now. And you decide that you're going to sell at 5 million. So this is where you're going to sell the property at 5 million. And after some costs, it becomes, you have 800K. And again, that becomes then distributed depending on your structure. So it's 50-50, you split the 800K and you each pay tax on it. If it's a unit trust, again, it's divided into the 4 people, so each one gets 200K and you pay tax on it. If it's a company, you pay tax on the profit of the 800K and then everything's distributed, and then there's a franking credit for you to claim. So that's really how you look at, structuring the deal is what are you getting in your cash and what are you getting in your uplift? So when we look at any kind of syndication, look at syndication, we're looking at cash, we look at cash distribution, we look at profit share, at conclusion, so at the end, and we look at timeline, as in how long it's going to take you to complete the project. On the other side, what we look at, so this is what I call syndication outcome. On the other side, what we look at is what is your investment. So one, your investment is money in initially. So when we talked about, when you're putting the money in for the initial buy, whether it's a cash raise, whether you're getting any loans from the bank, it's money in. 2, future commitment. So, when you go and borrow the money from the bank, what is it that you do? So when you borrow the money from the bank, do you go, okay, I'm borrowing the money from the bank, so therefore I need to come up with $80,000 as a group. So each year it's going to cost me $20,000. While I'm doing the build process in the next 2 years, I have to come out of, that $20,000 has to come out of my pocket for the next 2 years. So that's your future commitment. So your money in, your future commitment, and then we need to look at opportunity costs. So what is the opportunity costs for you in the future? Right. So if the property is going to go, if the deal is going to go for, let's say, 3 or 5 years, and in the beginning, for the first 2 years, you might have, $20,000 or $40,000 in passive income, depending on how you structured the deal. But then in the future, you might have to commit another 100 grand. And then you're going to basically have your initial money in plus the 100 grand committed there for the next 3 years. You got to look at, is this worthwhile a deal for you? And that's really the simpleness of syndication, is to work through what exactly is that works right for you, and what are the commitments going forward as well. So they're now giving you a layout of what the property, how to actually structure a deal, a syndication. I want to share with you one of the deals we've done recently. So one of the first deals, so you can see the difference. I'm going to actually talk about 3 different deals with you. So the first deal we did was in Townsville, in Heatley in Townsville, and this is a childcare centre. We bought that for $3.85 million. And what happens is that property already had a childcare centre in there. It had 7 other shops. 3 of those was tenanted, 4 of those were vacant and really needed a refurb. So for us, when we raised money, we raised it enough to buy the property with obviously a loan at 50% and also enough money to be able to do the refurbishments on the actual property. We are then going to go through a subdivision process, and we actually subdivided the process and we subdivided the childcare centre and had the childcare centre already agreed to buy it back at a certain price point. And then now, we are almost finished 18 months subdividing. We refurbished some of the shops, have 1 tenanted, have a few more to go. But we are now focusing on finishing the subdivision. And then once the subdivision is finished, we're going to sell it back to the childcare centre, be able to repay some of our investors, and also then, take a lesser loan on the property itself as well. The deal that when we structured it was that because of the income already getting on the property, we were distributing a 7% net return to the investors who put their money in, and we were doing it under the Uni Trust. That was our first deal, so we did it under the Uni Trust with less than 20 people, and we basically were distributing 7% of their investment into the deal, and they were going to get a part of the back end when we actually sell the rest of the property. So when we sell the childcare centre, and also then when we sell the actual the rest of the shopping centre as well. So that's one of the deals. That's very simple. That's your simple, straightforward syndication. The next one we did is we did an Albury medical development. So this had investors in there again. We raised money under more of a unit trust structure, and we what we did with that property is that it actually had no distributions at the front, but everything in the back end. So the property itself was, well, we bought it under market, and we bought it at probably less than $100 a square meter, but it needed a lot of refurbishment. So just to remove the asbestos alone was about 100 grand plus, because you had to remove then the air conditioning and the stuff on the roof as well. But that property we bought for 1.4. We'll probably spend 200,000 or 300,000 just to tidy it up. And now we've decided, after going through and doing the visa study of the property, instead of just tenanting it to any tenant, which we might get somewhere around $150 to $180 a square meter, we're better off to make it a medical build. So turning into a medical build, applying for 12 medical suites in there, getting it built. Now we've changed it to $450 a square meter. So that is already just released on the market for pre-sales and pre-leasing before the DA comes in the next 2 months. So that property's probably been, we've been doing that project for about 2 years, just on 2 years, and it'll be completed mid next year. So that'll be a 2.5 year project, but the back end gain is likely to be 30 to 40% of that as well. So that is another way of doing it, where you're doing no cash at the front end, but all of the distributions are back end for profit. And then finally, other ones apart from, we've obviously done quite a few, but this particular one is self-storage. And with self-storage is one of those things that it actually starts out as a much lower return, because most self-storage are not properly run unless you're a Kennards or Storage King. They're not properly run, so you need to put in a system, a new marketing, new website. You need to get things all structured and properly. You need to then talk to all the clients in there, and there's usually structural works to be done on the property, which we did. We replaced the roof, we put a lift in the property, we put in new systems, new marketing, about to paint the building, new lighting, changed a whole lot of that structurally, did the driveways, about to put new security in there, all the things that we did to actually do capital work on the property, and then get architects to to do the internal to change a bit of the layout, and then of course getting internal fitted out so we can do more storage units inside the warehouse. So with that in mind, you start off with very low returns, about say 4%. But over time, it is a slow build over the first couple of years, but then it dramatically goes up. And what we are seeing is somewhere around the lines of what we are going to get is a double-digit returns in year 4 and 5 on this property, and then also a massive back end as well. So that kind of property starts off with a lower return, but it grows over time, which is great because as the market yields are compressing, this property is also compressing. It's actually growing, giving you better returns in the market as we go along. And that's again a different structure. So each and every one of these deals are different. Each and every one of a group deal syndication is different. And the reason you would choose to do one over the other is those 3 things I look at. Look at the time, look at the commitment you have of funds initially, look at any future commitments of funds, and look at your opportunity cost. If you did a direct investment of 300,000 and you put it into a let's say 300,000 into a property yourself, what kind of returns would you get compared to put it into a syndication? And most of the time people do syndications because they can't get access to larger and bigger deals, is so that you can get access to your $3, $5, $10 million deals. That's why you do syndications, because it makes it worthwhile and it costs less for everyone all around. And the back end, it takes out the everyday Australians investing. And so you're in a different price bracket, which means that you are actually going to get much, much higher returns on the back end if you play your cards right. So if syndication is what you're looking for, or if you have 2 or 3 friends that you want to put a syndication together, one of the first steps to look for is to, put together a heads of agreement or an understanding of how it's going to work. Do a feasibility, which is what we do. We put spreadsheets together and we run the spreadsheet of, how much distribution you're going to get, how much returns, how much of the cost. We need to run that spreadsheet so that you understand exactly how the deal works. And then on top of that, it's a meeting of the mind, exactly how many people are going to put in how much. And you have an agreement, even though you're friends or you're working with colleagues, you still have an agreement in place, and you make a formal plan and you execute the formal plan going forward. So moving forward, if this is something you are interested, and if you have someone together that you think want to come together and do a syndication, but you actually don't know how to, and you're curious to see how you can put one together where you can access larger deals, reach out to me, Helen at commercialpropertycashflow.com.au or helentarrant.com, and I can walk you through the process. I can talk to you and your investors together. I also do source and help buyers agencies specializing in finding particular deals for syndications as well. So again, I'm here to build a portfolio and to create wealth for you through commercial property. We're not transactional. We're all about the journey with you. So reach out to us. Let's see what we can do together, because I'm sure together we can achieve amazing things. So until next time, happy hunting, and I'll see you on the next episode. Bye for now.